Let's check in with Ines Ferre now, who's live for us in our studio with a look at some of today's big tickers. And Ines, I know UPS on your radar, disappointing investors with that delivery number.
That's right. With investors seeing a slowdown in deliveries in the U.S., down 3% year over year. Ground deliveries volumes also down. So we're looking at UPS that's down 7%, 7.5% after its quarterly results. If we just take a look at a year-to-date chart before these results came out, year-to-date the stock was up 25%. You can see it's still year-to-date up 15%. Of course, we are comparing the quarter to that of last year, which was really, of course, in the thick of the pandemic. So you would be expecting to see a slowdown. Last year, people during this time were really hunkered down in their homes and ordering online. Alexis?
All right, Ines, let's talk now about the airlines, specifically JetBlue. I know the coronavirus meant that folks were able to get very low fares. It looks like that is now over.
Yes, that's right, because the fares have increased and we are seeing JetBlue down 7% off of its quarterly results. Cost projections is really what is concerning investors, those going up. But as you mentioned, those fares, that leisure fares are now at the 2019 levels. Those reached the 2019 levels this month. So if you are taking a flight, I'm sure that you've noticed, if you've taken a flight recently, you're not getting big discounts like you were in the thick of the pandemic last year. Also, some interesting commentary from JetBlue regarding its capacity levels, that it is seeing that those capacity levels will be largely restored in the third quarter. And also, I want to mention the COVID variant Delta, because they did mention that COVID variant, saying really that it has not affected travel. And as we can see, you're looking at fares that are higher, people that are traveling more. The stock, though, under pressure because of those cost projections.
And also, I'm looking at our trending tickers page on the site, and I see GE is there, getting a nice bump today on news, better than expected news, I guess, about their free cash flow.
Yeah, that's right. That free cash flow projection coming in better than what the street had been expecting. The company did beat on the top and the bottom line. It's the free cash flow that's really that was bumping the stock up. Of course, we've got the overall markets that are down today. The stock is up just 1%. The results also, GE saying that were driven by its healthcare and services. Aviation also showing some early signs of recovery. But I do want to show you, over the last 3 months, GE has really been trading in this range around the $13 level. If we take a look at a 6-month chart, it's up 14% over the last 6 months. Year to date, up 20%. But GE is one of those stocks that you can easily see at these kinds of levels for quite a long time. This 13 share level, $13 a share level over the last month. Today, seeing a bit of a bump despite the overall markets that are down.
All right, Ines, at the start of our show in the last hour, I talked about 2 Chinese automakers which are under pressure. I know that you're looking at some Chinese-based stocks as well. A lot of pressure, as you can see, a lot of red across that screen over some of those regulatory fears. Give us some more details there.
Yeah, that's right. We are seeing a lot of red with these Chinese-based stocks. You've got Alibaba that's down more than 5%. NIO, as you were just mentioning, down 9%. I do want to mention the Hang Seng, the Hong Kong Hang Seng closed down more than 4%. Over the last 2 days, it's lost about 8% because of regulatory issues, concerns, fears in Beijing with Chinese companies. So you are looking at, if we just take a look at a 5-day chart, you can just see Baba down 14% over the last month. Baba down 20%. NIO down 13%. You can just see Pinduoduo down 38%. You can see the heavy sell-off that we've been watching in these Chinese-based stocks. And also, I want to mention Hello. This is a company, a Chinese-based bike-sharing company. It was planning its IPO that was going to happen on the NASDAQ, hoping to raise some $100 million. The company has now scrapped that IPO. So just to show you the delicateness that we're looking at when it comes to these Chinese-based stocks.
For sure. All right. Ines Ferre, thanks so much.